Welcome to Market Brief After Hours. We have a lot of ground to cover today. The markets are flashing red across the board, and the backdrop is incredibly tense. We are seeing an escalating conflict involving Iran, Israel, and the United States, and that is sending shockwaves through energy supply routes. It feels like volatility is the only certainty right now.
That is exactly the reality investors are waking up to. We are looking at a classic geopolitical shock, but one that is hitting at a very vulnerable time for the global economy. The expansion of strikes on critical infrastructure across the Persian Gulf is disrupting energy supplies, which immediately translates to surging oil prices. And when oil surges, the immediate fear is inflation. We were just starting to see central banks get comfortable with the idea of cutting rates, but this kind of energy-driven inflation could force them to keep policy tighter for much longer.
Let us get right into the numbers, starting with Wall Street. The major indices took a significant hit today. Walk us through the damage.
The selling pressure really deepened as we moved into the afternoon. Looking at the Dow Jones Industrial Average, it fell by 0.96%. To give you the exact rounded figure, it closed at 45,577. That puts the Dow dangerously close to correction territory. It is a clear reflection of investors pulling back from risk and bracing for global uncertainty.
And the S&P 500. It usually gives us the broadest picture of market health.
The S&P 500 didn't fare any better. It dropped 1.51%, closing right at 6,506. What stood out today was how broad-based the selling was. It wasn't just one or two sectors dragging the index down. The losses spread across nearly the entire board. Even though the S&P has held up slightly better than some other benchmarks recently, it is now down 7.3% from its recent high.
That brings us to the tech-heavy NASDAQ, which seems to be bearing the brunt of this shift in sentiment.
Absolutely. The NASDAQ composite slid sharply, falling 2.01% to close at 21,648. We saw notable declines in the mega-cap technology names that have been driving the market for the past year. Nvidia and Tesla, for example, both dropped around 3%. When bond yields rise, which is happening right now due to those inflation fears we mentioned, growth stocks with high valuations become incredibly vulnerable. The NASDAQ is now teetering on the edge of a technical correction.
You mentioned bond yields and oil. Let's dig into those commodities and rates because they seem to be the engine driving this equity sell-off.
They are the primary catalyst right now. Oil markets rallied aggressively today. Brent crude surged 3.26% to settle at $112.19 per barrel, while WTI crude gained 2.27% to hit $98.32. This isn't just speculative trading. There are real physical supply disruptions. Iraq actually declared force majeure on oil fields operated by foreign companies, and we saw attacks targeting key infrastructure in Kuwait. Add in the disruptions to shipping through the Strait of Hormuz, and you have a recipe for a massive supply squeeze.
And how is the bond market reacting to the prospect of $112 oil?
By pricing out rate cuts. U.S. Treasury yields jumped across the curve. The 10-year yield rose to 4.39%, the 2-year climbed to 3.89%, and the 30-year is knocking on the door of 5%, reaching 4.96%. The bond market is essentially signaling that persistent inflation is back on the table, and the Federal Reserve might have to keep their foot on the brake.
This isn't just a U.S. story, though. The European markets were also caught in the crossfire today.
Yes, the contagion was global. European equities actually started the session with some gains, but those completely reversed as the oil surge and rate outlook weighed on sentiment. The Pan-European Stock 600 closed down 1.7%. Looking at individual countries, the UK's FTSE 100 fell 1.45%, and France's CAC 40 declined 1.83%.
Germany seemed to take a particularly hard hit.
Germany's DAX dropped around 2%, which marks its lowest level since April 2025. We also saw notable losses in Italy with the FTSE MIB and in Switzerland with the SMI. The economic data coming out of Europe isn't helping the mood either. German producer prices did fall by 3.3% in February, mostly due to a previous drop in energy costs. But with oil spiking again today, investors are terrified of future inflation spikes. Over in the UK, public sector borrowing hit £14.3 billion in February. That is the second highest on record for that month, reflecting the rising costs of public services and debt interest. On a slightly different note, the Eurozone's current account surplus did widen in January to 37.9 billion euros, but that was overshadowed by the broader geopolitical gloom.
It is a heavy macro environment to digest. We are going to take a quick break, but when we come back, we will dive deep into the currency markets, look at the technical breakdown in precious metals, and highlight some incredible individual stock movers that bucked the trend today. Stay with us. Welcome back to Market Brief After Hours. Before the break, we covered the macroeconomic shockwaves hitting equities and energy. Now, let's look at the foreign exchange markets. The US dollar seems to be reacting strongly to these shifting rate expectations. Let's start with the euro.
The euro is under severe pressure. USD-euro closed at 1.1557, down 0.27% for the session. From a technical standpoint, the bearish momentum is holding very firm. The pair is trading well beneath its key moving averages. It is below the 50-day simple moving average at 1.1729, the 100-day at 1.1686, and the 200-day at 1.1675. What is concerning for euro bulls is that these averages are beginning to align as overhead resistance. We have a clear sequence of lower highs and lower lows since late January. Immediate support rests at 1.1524, and if selling persists, we could easily see an extension down to the 1.1500 psychological level.
And the British pound? Did it fare any better against the greenback?
Actually, it fared worse. GBP USD broke lower today, closing at 1.3333, which is a drop of 0.73%. The pair completely failed to hold above its key averages. It decisively sliced through the 50-day SMA at 1.3507, the 100-day at 1.3399, and the 200-day at 1.3436. Breaking below that 1.3400 to 1.3430 support zone is a major technical event. It confirms a shift to a bearish bias. Sellers are firmly in control here, and if weakness extends, we are looking at support way down at 1.3299 and potentially 1.3200.
The Japanese yen has been a major story lately. How is USD JPY behaving in this risk-off environment?
It is pushing relentlessly higher. USD JPY closed at 159.30, up 1.03% today, holding near multi-year highs. Unlike the European currencies, the uptrend here is completely intact. The pair is trading way above its moving averages. The 50-day is down at 156.51, the 100-day at 156.29, and the 200-day is all the way down at 152.00. Bullish momentum is dominating. With no immediate overhead resistance on the charts, the market's focus is shifting directly toward that massive psychological level of 160.
Now, usually in times of geopolitical stress, we see a flight to safety in precious metals. But looking at the charts today, gold and silver took an absolute beating. What happened?
It is a bit counterintuitive, but when you have a day where the US dollar surges and Treasury yields spike as aggressively as they did today, non-yielding assets like precious metals get crushed. Gold closed at $4,497, down a massive 3.36%. It broke decisively below the 50-day SMA at $4,964 and the 100-day at $4,582. It is still holding above the 200-day SMA at $4,066, but the momentum has shifted strongly to the downside.
If gold's drop was bad, silver's looks catastrophic.
Catastrophic is the right word. Silver dropped sharply, closing at $67.70. That is a 6.77% decline in a single session, ending right at its daily lows. It broke well below the 50-day SMA at $86.22 and the 100-day at $72.55. The sheer magnitude of this decline signals intense bearish momentum. If this sell-off extends, we could see silver test the $64 level.
Let's pivot to individual areas. Even on a dark day for the broader market, there are always massive movers. Supermicrocomputer was the worst performer in the S&P 500 today.
Yes, Supermicrocomputer plunged more than 33%. This wasn't a macro-driven move. This was a company-specific disaster. The U.S. Attorney's Office indicted 3 executives over alleged export control violations. When legal charges of that magnitude hit the C-suite, institutional investors run for the exits immediately.
We also saw some heavy selling in the materials and semiconductor spaces.
Exactly. In materials, Mosaic dropped more than 9% after Freedom Capital Markets downgraded the stock from hold to sell. But the broader pain was really felt in the chip and AI sectors. SanDisk was down over 8%, Western Digital lost more than 7%, Seagate and Intel both fell over 5%, and Micron dropped more than 4%. When the Nasdaq slides on yield fears, these high-beta semiconductor names are usually the first to be liquidated.
It wasn't all bad news, though. The space sector seemed to completely ignore the broader market panic today.
The space sector was the major bright spot. York Space Systems surged 19% today. They reported full-year revenue of $386.2 million, which handily beat expectations of $383.5 million. And then you had Planet Labs, which jumped an incredible 25%. They issued very strong forward guidance, forecasting 2027 revenue between $415 million and $440 million. That absolutely crushed the consensus estimate of $379.6 million. It goes to show that even in a highly volatile risk-off environment, markets will still reward exceptional fundamental outperformance.
It really highlights the importance of individual stock picking when the macro environment gets this challenging. To wrap things up, how would you summarize the current state of play for investors heading into the next few sessions?
The market is currently defined by tightening financial conditions and incredibly fragile risk appetite. Equities are struggling to digest the 1-2 punch of higher energy prices and rising bond yields. With major indices sitting right on the edge of correction levels, sentiment has deteriorated rapidly. Moving forward, downside risks are building. I expect markets to remain highly reactive. Right now, price action is going to be driven less by long-term fundamentals and much more by shifts in positioning, liquidity, and whatever the next geopolitical headline happens to be.
A very critical time to be paying attention to the markets. Thank you for walking us through all of that data today. If you find this useful, please follow Market Brief after hours.